Hello, and welcome to Team 1's presentation covering Archer-Daniels Midland Audit Planning.
First, we're going to take a look at how ADM, executive compensation, affect fraud risk. So according to ADM 2024 proxy statement, executive earn bonuses, restricted stock units, and performance stock units are all based on adjusted return on invested capital, net income, and segment operating profit. Because their compensation is tied to those financial target, it creates a lot of pressure to hit those figures, especially in the nutrition segment, which did not do well. When there's pressure like that, it increases the chance of things like management overrides and shifting revenues or adjusting intersegment pricings just to meet the earnings goal. And per item 9A of ADM's 2024 10K, the company already reported a material weakness in ICFR over intersegment revenue and segment reporting. So now you have strong incentive and weak control in the same area. Next, we can take a deeper look into ADM ICFR weakness. According to item 9A in the 2024 10K, ADM has a material weakness, specifically in intersegment revenue and segment reporting. This requires attention because weak control can allow both accidental error and intentional override. So when it's paired with compensation pressure, like from the proxy statement earlier, we get a situation where the opportunity and incentive overlap, which is exactly where fraud risk become the highest. Basically, the control weakness makes it easier to manipulate result, and compensation structure gives the reason to do so. For identified risk, my slide focused on revenue recognitions and intersegment sales. ADM has a huge transaction volume globally, which already adds complexity. On top of that, intersegment pricing is complicated and directly affects segment profit, which again ties back to the bonus per the 2024 and 2025 proxy. We also have the material weakness report in the 2024 10K and also an ongoing SEC and DOJ investigation into nutrition segment. So when you put it all together, high volume, complex pricing, compensation pressure, a material weakness, and an active investigation, revenue and intersegment sale clearly shows a very high risk area. To respond to this risk, my tests focus on accuracy, cutoff, and potential management override. First, we'll recalculate intersegment pricing using ADM's internal pricing schedule per the 2024 10K to make sure pricing is correct. Then we'll trace sale to invoice, contract, and shipping documents to confirm the right timing and the right segment. Because bonuses depend heavily on year-end performance and per the proxy statements, timing is a high-risk area. We'll do 10 days pre- and post-year-end cutoff testing to catch early revenue recognitions. We'll also run margin analytic for the nutrition segment to spot unusual increases. We'll test late manual journal entries, since these can indicate management override. Finally, we'll compare segment trends to expectation and look into anything that seems off. So overall, we'll use inspection, recalculations, analytic, cutoff testing, and journal entry testing. For the timing, we'll only do walkthroughs at the interim to understand the process, but all substantive testing will be done at year-end. Since there is a material weakness, we have to increase the extent of testing. So we'll perform high extent substantive work, which means larger sample size, expanded cutoff testing, and deeper journal entry testing.
The next factor we considered in ADM's audit planning was its financial position. We considered profitability, liquidity, and solvency ratios in order to form an opinion about going concern. We found that ADM had experienced a period of steady growth, but in 2024, its profitability dropped sharply. Both gross margin and net margin were down over 1%. Given what we know about executive compensation, we feel this further substantiates that there's likely pressure on executives to improve performance around profitability. We found liquidity to be relatively steady over the last 5 years. ADM's quick ratio is holding steady at around 0.33, and its current ratio is holding steady at about 1.45. While ADM's quick ratio is not highly concerning, we do find that they're less liquid than their top competitor, which means that ADM does need to sell inventory in order to comfortably cover short-term obligations. Given the profitability drop in the last year, if this trend were to continue, there would be concerns from stakeholders. We also found that solvency had a period of steady improvement, but declined again in 2024. ADM's debt-to-equity ratio surpassed the 0.5 mark in 2024 after reaching a 5-year low of 0.39 in 2023. This means that ADM has become more reliant on debt since 2023. It's still a reasonable ratio for the industry, and it's also below its top competitor, so nothing highly concerning here either. Given our findings, we have no substantial doubt about going concern in the next 12 months. We also considered ADM's internal controls over financial reporting in audit planning. From publicly available resources, we found that ADM has a code of conduct that establishes high standards for honesty and integrity, which speaks to its tone at the top. ADM also has an independently managed anonymous helpline available for internal and external stakeholders to report concerns that are taken seriously and investigated. This speaks to existence of its monitoring activities. Lastly, we also found that ADM has internal policies and programs in place to improve compliance in many areas. It speaks to its control activities. These controls would be tested in the interim and would drive the extent of our substantive testing. Given these considerations, we've identified the following risk that will lead to a specific design test. As we mentioned, margins fell sharply in 2024, and ADM became more leveraged in 2024. If both of these trends were to continue, stakeholders would become increasingly more concerned with the company's liquidity and solvency. This means that there is pressure on management to reverse these trends. The profitability decline creates incentive to manipulate expense accruals. Liquidity pressure creates the potential incentive to delay or misclassify short-term liabilities. The solvency decline creates an incentive to understate liabilities. This risk, we would test ADM's accounts payable balance and their accrued liabilities in an audit. We would do this through a number of tests varying in nature, timing, and extent. Using analytics and in the interim, we would calculate key accounts payable ratios such as AP turnover and days payable outstanding, comparing to prior periods, to give us some clues on where there are concerning fluctuations and where testing, substantive testing may be needed. Next, using an inquiry type test, we would talk to management in the interim about how they estimate their accruals and about any non-standard vendor terms. This would also help drive our substantive testing. Next, we would use an observation test in the interim to observe AP's workflow and confirm that any internal controls that ADM has surrounding the workflow are in place and working properly. The next step is the first step we would perform at year-end and is an inspection test. We would inspect a sample of subsequent payments, payments that happen after close, and we would verify that those payments are recorded in the correct period, accrued to the audit period if necessary. The extent of this test would be based on our findings in tests 1 through 3. The other type of test we would inspect is a confirmation. We would send confirmation requests to high-volume vendors to confirm that ADM's payable balance matches the vendor's receivable balance. This would ensure that there's no missing or extra expenses recorded on ADM's books. Finally, we would use a recalculation test to recalculate ADM's accruals based on the accrual estimate methods that we learned about in Step 2. We would compare that to ADM's work papers and ensure that everything is reasonable and as it should.
On this slide, I'm talking about the two biggest problem areas at ADM. Auditors always focus carefully on these areas because PCAOB-AS 2101 paragraph .07 says that when something is high risk, auditors need to plan more work and test more carefully. ADM is a huge, complicated company, so these risky spots really stand out. First, the fast-changing financial deals. ADM signs financial agreements that change value every single day based on things like corn prices, oil prices, or world currencies. Imagine trying to guess the price of something while it changes every hour. That's what ADM's accountants have to do. Because the numbers move so fast, it's easy for mistakes to happen. For example, if ADM records the wrong price for just one big corn deal, it could change the financial statements by millions. Second, inventory value mistakes. ADM stores massive amounts of corn, soybeans, wheats, oils, and other products in massive amounts. Similar to the deals, these products don't keep the same price for long. If the price changes and ADM doesn't update the value, the financial statements could show too much or too little money. Imagine ADM holds thousands of tons of corns and the price suddenly drops, but the numbers on the books aren't updated. That creates a big problem. Or think about soybeans in another country where someone miscounts the inventory. That could create a chain reaction in the financial statements. ADM is a giant company, so they have a lot of systems in place that help reduce mistakes, also known as ICFR. PCAOB-AS 2101 paragraph .08-.10 says auditors must understand these controls before planning the audit, which is really important for a company as large and complicated as ADM. One helpful thing ADM has is strong controls. For example, the board of directors reviews important reports, managers approve big decisions, and advanced computer systems track money and products. This is having multiple layers of checks to catch mistakes early. ADM also has strong end-of-year checks. Before releasing their financial statements, they review the numbers, compare them to last year, and check for anything that changed too much. This makes it easier to catch errors before the numbers go public. Another helpful control is ADM's monitoring across different countries. Because they operate worldwide, teams watch for unusual activity, like sudden changes in sales or inventory. For example, if corn shipments in a country are suddenly recorded differently than last month, a team would flag it. Even with these controls, ADM still has risks. Fast-moving deals and changing price inventory are especially tricky. If internal controls aren't followed perfectly, mistakes can happen. On this slide, we're looking at the main risks identified for ADM. PCAOB-AS 2101 paragraph .07 says auditors must pay extra attention to areas where errors are more likely, and these two areas at ADM clearly fit that description. The first risk is fast-changing prices. ADM has financial deals that change value every day based on things like corn prices, oil prices, or currency exchange rates. These numbers are extremely volatile. If ADM records the wrong number or doesn't update it quickly enough, the financial statements could be wrong. Even a small delay in updating the numbers could mean the financial statements are off by millions. AS 2101 paragraph .05 tells auditors to plan extra work whenever numbers are hard to measure or move quickly, so this becomes a clear risk area. The second risk is large inventory. ADM stores massive amounts of corn, soybeans, wheat, oils, and other products around the world. Prices for these products also change all the time. If ADM doesn't adjust their inventory values correctly, or if products are counted incorrectly, the total number on the financial statements could be off. AS 2101 paragraph .07 and .16 highlights that accounts with big balances, lots of activity, or lots of locations are naturally risky. ADM's inventory fits this perfectly. On this slide, I'm talking about the audit test for ADM's fast-changing deals. For the test description, basically, the auditors are checking every big deal to see if the value ADM recorded matches reality. They look at the models ADM used to estimate values and the inputs for these models, making sure that nothing is missing or calculated incorrectly. The nature of the test, auditors do a few different things. They ask banks and other financial institutions to confirm the balances. They also recalculate the values themselves using the current market prices and make sure ADM's numbers are correct. Finally, they look at trends and patterns in the numbers over time to check if anything seems unusual. For timing, most of this testing happens at year-end when the final numbers are being prepared, but auditors might also do some checks during the year to catch big mistakes early. Finally, the extent. Because this account is very risky, auditors test all the large balances and focus on the most complex contracts. The more complicated the deal, the more careful the auditors have to be. Now let's talk about the audit test for ADM's inventory. This is an account auditors considered high risk under PCAOB AS 2101 paragraph .07. The test description, basically auditors are checking both the quantity and the value of ADM's inventory. They go to the warehouses, look at the products, compare the number ADMs recorded with what's actually there, and make sure the costs are correct. They also double check any unusual items or products stored in multiple countries to make sure everything adds up. For the nature of the test, auditors do a few different types of tests. They inspect the products to make sure they exist, observe counting procedures to ensure staff are counting correctly, recalculate the total value using cost information, and use analytics to compare inventory amounts and prices to historical trends or market prices. For the timing, most of the testing is done at year-end, when the financial statements are being prepared. But auditors also do some interim spot checks during the year to catch any big mistakes early. Finally, the extent. Because ADM has so much inventory in so many locations, auditors focus on the largest amounts and highest risk locations. They test more carefully where the product's values change frequently, like corn or soybeans.
Thank you for your time and attention to Team 1's presentation.